One of the things that's really surprised me in 2018 is that capitalization rates have not followed interest rates as they've gone higher. And I think that there's three primary reasons this has happened. First of all, it's true that interest rates have gone higher, but only the risk-free rate. And so in real estate, you measure the risk-free rate two ways. One is LIBOR, the interbank lending rate, and that's most affected by the Fed funds rate. It tends to track it. The Federal Reserve has been tightening, and that rate has gone from about 30 basis points to now it's about 175 basis points. So a dramatic increase in the LIBOR. And the reason LIBOR matters is all of our variable rate debt is priced over LIBOR. And so when you hear a term like it's 400 over, it's 300 over, what they're really saying is it's 300 or 400 over risk-free LIBOR, which is $1.75 at this point. So your all-in rate, if I said 300, is really 475. The other rate that we look at is the 10-year note rate. That's also a risk-free rate, and that's gone in the last, we'll call it year, from roughly 2% to roughly 3%. So again, a dramatic increase. So why has my borrowing rate really not gone up nearly as much? And the reason for that is I don't borrow at the risk-free rate, I borrow at the risk rate because I'm buying assets that have risk. A real estate building is not a 10-year bond guaranteed by the US Treasury. So those spreads from those lenders, as the risk-free rate has gone up, the spreads have come in dramatically. And so whereas before I was paying 400 or 500 over a LIBOR that was 35 basis points, now I'm paying 300 or 400 over a LIBOR that's 175 basis points, but my total borrowing cost has probably only gone up nominally. And it's the same way with fixed debt. Fixed debt is priced over the risk-free rate, but those spreads have come in. So the first reason that you haven't seen cap rates go up is what drives capitalization rates higher is actually the total borrowing costs. And the total borrowing costs really haven't gone up. What's happened is lenders have been willing to take a lower margin. They've done that because they also believe that the economy is growing and that rents are growing and that generally the risk at the asset level is lower. So that sort of segues into the second reason that the capitalization rate hasn't gone up to sort of trend with interest rates is that the belief that not only rents are going to go higher so that you're going to build your capitalization rate back over time through higher NOIs, net operating income at the property, but also that the asset levels themselves are going higher. So people on the equity side are willing to take lower returns today in terms of the yields they buy in exchange for what they believe will be higher returns in the future. The third reason is that there's a tremendous amount of private capital that's looking to purchase private assets. And so there's a lot of money that's been raised by real estate private equity funds, REITs, private REITs, family offices, foreign capital, and all of this capital is competing for assets. And so what we're doing at Origin, really in the face of what I would deem certain instances where people are overpaying for assets, in other words, the expected return that they're getting for a unit of risk seems a bit low to me, is we don't participate. And so for firms like ours, it's gotten harder and harder and harder each year to deploy our capital, but we're still able to do it, but we have to work harder and harder to do it because there's so much private capital chasing the deal.